a lot of talk, of course, about economic conditions, whether they're deteriorating, whether the market has sort of priced in enough of that deterioration.
The bond market looks like it's pricing in the deterioration with the 10-year long end of the yield curve going down now. Stocks are still skeptical because employment's still up and generally earnings are still up, even though there's the expectation they're going to slow first half of this year. So in our view, there is a reason stocks are still up. Whatever they expect, whatever's going to happen in the first half of the year is expected to be shallow and short. That's what stocks are telling us.
Who's right, the stock market or the bond market?
Usually the bond market, but the bond market and the Fed are doing this right now. So they're going at each other right now. And the stock market, we would say December is going to be about the bond market. January is going to be about the stock market.
Why is that?
Earnings in January.
New money being put to work in January.
Yep, and then this month, three things. Inflation on the 13th, Fed on the 14th. Congress has to do a budget on 16th.
Yeah, well, and by has to, they probably won't because this is Congress.
Extended 2 weeks or until January 3rd or whatever.
See, the can is being kicked down the road.
They're required. That's a whole nother conversation.
But to us, it's more of a bond month.
Yeah. And,
stock month.
And we'll see a lot more of the reaction probably in the bond market to some of those issues is basically what you're getting at.
Yep.
Talk a little bit, though, about the equity market and about finding opportunity to invest there. Let's move forward into 2023 here. Everyone wants to know what the leadership is going to be. Do you move back to the Apples, Amazons, the old tech leadership, or do you go for something that has actually proven itself, like energy, utilities, et cetera, something more defensive?
So give you a view, our equity team, they're still using the big tech names more as a source of cash because they're probably not going to stabilize till the Fed calms down rate cycle. Now, what we are noticing comes from Bloomberg, the projections for earnings estimates next year, 3 early cycle sectors, discretionary, industrial, and financial. So our team is what they call, our equity team's barbelling. So they'll put in a defensive name, but they'll put a cyclical in at the same time. Gotcha. So baby steps and barbelling.
What about energy? Where do you see that headed, given that oil prices are so much in focus and OPEC Plus still hasn't figured out what it's going to do moving forward? But we know that there's tremendous supply concerns, supply issues. There's tremendous demand concerns, demand issues.
Our view is it's probably come down too far too fast. Just this month, probably come down too far too fast. Futures market is starting to say the same thing. So we would say the thirst for energy globally is going to be multi-year. It's going to be multi-year, right or wrong, and so our equity team's looking at energy again.
And when you mention energy, you're talking fossil fuels. So so the idea, and that seems to be what investors have been making a bet on pretty much all year long. That sort of the death of fossil fuels. So maybe
I mean even uranium and coal and natural gas, all 4 of them, and crude oil are up.
Yeah, I am curious though when it comes to the energy space here, do you try to allocate in a way that also sort of looks to renewables and maybe captures what a lot of people think at some point is going to be our future?
Not yet. So our equity team's playing that mostly through the industrials.
Gotcha.
Who's making the gadgets to put the green energy in, the vehicles or whatever it is, or the factories. They're still playing energy across the board, the producers, the refiners, the distributors, so to speak. So they're still across the board there.
Okay, you said December is going to be bond month. What are you doing with your bond strategy for 2023?
We moved in February, so we shortened duration, increased quality in February of this year. We've kept that stance. It's worked. It's worked. The Fed expectations, dot plots, SEP, whatever you want to call it, comes out December 14th. That'll probably be a precursor to what our fixed income team does next. Whether they go long or not. Because what's most interesting to us about that Fed meeting on the 14th, if they go 50, which is the expectation now, the consensus for that would put them at 450. The inflation expectation for next year is at 4.3%. That's going to give them, in our view, flexibility as long as that expectation stays down below 4.5%.
Have you been comfortable with the communication that we've gotten out of the Fed members so far?
The over-communication has been a source of a lot of volatility this year. It's been a source of, they are the source of volatility this year, stocks and bonds.
But are they singing from the same hymn book?
Can't answer that. Don't know the answer to that question. They rally around Jay Powell, certainly, but don't know the answer to that.
But I'm curious. I mean, compare it to sort of, I mean, the Greenspan era, where he was basically as tight-lipped as anyone, and of course, that was before the press conference era, and even the folks around him didn't have the freedom to speak in the way that the Fed members have to speak today.
What's caught our attention most about the Fed hasn't been reported a lot. It was in their statement of economic projections, September 21st. They said economy in the U.S. was going to grow 0.2% this year, 1.2 next year, accelerate.
That's a big move.
The economist's consensus says it's going to decelerate from 1.4 to 0.8. I've been doing this 30 years. I've never seen the Fed and the bond market fight all the time, but I've never seen them go against economic consensus. So those projections are going to be really interesting at that December 14th meeting.